there's this widespread belief that the Treasury market is breaking down, that there's been a loss of faith in U.S. securities for a variety of reasons, many of them having to do with partisan politics, nothing new there. But it's pervasive, it's everywhere. I've been traveling around quite a bit this summer doing conferences and speaking, and people just, there's this overwhelming sense that this must be happening because everybody says so. And if everybody says that the Treasury market is breaking down, then it must be the case. Except we just got more data, concrete data, which just blows the whole narrative right straight out of the water. Foreigners are not ditching treasuries. They're buying them in massive amounts, to the point that U.S. Treasury holdings among foreigners in particular are at record highs. And as I said, the mainstream is sort of like, what the hell's going on here? We've been talking about everybody ditching treasuries, and here foreigners are buying treasuries. So we'll go over the details. Plus, I'll say for the end, the one real takeaway from the tick data that we really need to be concerned about, which is related to this topic too, of foreign ownership and foreigners selling treasuries and why they actually do so, and the related stuff that goes along with the U.S. dollar. So give me a second here, and we'll get everything set up, and we'll get started. All right. Like I said, there is this pervasive belief that the Treasury market right now is in the process of being, just disintegrated. Foreigners are fleeing. There's a loss of faith and confidence in U.S. Treasury, which is a huge deal because U.S. Treasuries are basically the backbone of the entire monetary system. Even people who don't really get too deep into the mechanics of Eurodollars, maybe not even know what Eurodollars are, understand intuitively how important the Treasury market and the Treasury securities have been, even if they don't get repo and collateral and derivative collateral and things like that. But like I said, there is this it is everywhere. A lot of it has to do when you go back to, for example, what happened in April. I think that shook a lot of people up, even though it shouldn't have, because we've seen this happen before. But back in April, things were melting down. Everybody wanted to flee into safety. And instead, what happened, especially longer-term treasuries, they sold off. And since nobody had an explanation, or most people didn't have an explanation, especially in the mainstream media, they weren't going to give it to you. You had treasuries that were supposed to be rising in price, falling in yield. At the same time, they're doing the opposite because everything was melting down, flight to safety. People got it in their minds that, oh my God, there's something wrong with the Treasury market. It is finally being rejected by foreigners. And we've been hearing this for years and years and years, not really connecting the dots here. The reason you've been hearing this for years and years and years is that it has not happened. So here we are in August. We got the tick data for June, so 2 months after April. Shocking, surprise, surprise. Foreigners are holding record amounts of U.S. Treasury. In fact, they bought a ton of them over the last couple months, that being May and June. So you have this 2-decade-old narrative, really goes back to the aftermath of 2008 and 2009. And it's understandable where this narrative comes from. The U.S. government is freaking broke. There's no argument about it. And it is getting broker all the time. And that is a massive problem for the world, just not the Treasury market. That's the thing here. It's not the Treasury market that is concerned about the U.S. government's increasingly perilous fiscal situation. It's really the real economy that suffers. And as the more the real economy suffers, perversely, that means there's more demand for U.S. Treasuries, which is exactly what we're seeing here. We're getting more evidence of the same thing, which is why this narrative has lasted for 2 decades without ever coming true. There's also the related dollar superstition, which is simply that everybody's ditching treasuries, so they must be ditching the dollar. That imperils U.S. dollar assets and the safe haven status and the general appeal of U.S. dollar assets all across the world. So all of these things are intertwined together. So we're going to do a lot of myth busting here with concrete facts and figures, unlike what the narrative usually is based on. Like I said, the debt crisis is real. It's just not a problem for the Treasury market. The Treasury market doesn't care about the long-run profile or even necessarily the long-run damage to the U.S. economy. In fact, as I said, the long-run damage to the U.S. economy, really the global economy, ends up perversely adding more demand for U.S. Treasuries in the future. But this thing has gotten so bad, this thing, by the thing I mean narrative, there are people out there right now shouting about how the Fed is going to have to institute yield curve control because long-term rates are going to skyrocket. And we've heard this before. And again, just like the narrative, it never comes true because the people who are shouting about yield curve control and loss of faith in treasuries usually get everything backward. In fact, in this case, they have got everything backward, and the data shows it. And then there's one chart at the end I want to make sure everybody gets everybody really highlights and we pay attention to is the background behind all of this. Why do foreigners own treasuries? Why do they occasionally sell them? It has to do with the dollar environment. And the real takeaway from the tick data for June, therefore the second quarter, is what's going on in bank balance sheets and their willingness to intermediate and even intervene and get involved in Eurodollar mechanics. So that's, I think, the big takeaway. Of course, everybody missed it because of all this Treasury business. The real takeaway is what's going on with the banking sector and what the tick data shows there. So let's start out with foreign holdings of U.S. Treasuries, what happened there. Blaring headline from Bloomberg this morning saying, oh my God, foreign holdings of U.S. Treasuries climbed to a record high. And you can even hear the surprise and shock just from the headline. And then the text really does it just even more justice. I mean, it's just, everybody says the Treasury market is experiencing this moment of lack of faith where everybody's ditching U.S. Treasury, especially foreigners. Foreigners hate Trump. They hate America. They hate everything. They don't like the way this is going. They hate the dollar. They're ditching the dollar. So this narrative is very much entrenched. So when the data comes out and shows exactly the opposite, everybody's like, what the hell's going on? We keep hearing that everybody's getting out of the Treasury market, and the opposite is true. And it's, like I said, it's related to these concerns over the U.S. dollar, which are completely unfounded too, completely separate topic. And you can even see, though, that even Bloomberg is in the text here. They're starting to become aware of how overhyped the one view, or the one gauge, they call it, of the U.S. dollar has become. That's, of course, DXY. DXY makes it seem like the dollar has really fallen sharply this year, and it has in DXY, but it's basically just the euro, and that therefore it does not necessarily represent the entire dollar system, or even just the entire range of dollar exchange values. In fact, as we'll see, it's entirely too narrow, and that when you see that and start to zoom out across the entire dollar space, these things start to make more sense. People are not ditching U.S. Treasuries. The dollar is not falling out of favor. The dollar isn't actually falling at all. And the reason why is what the tick data really specializes in, which is why we pay a lot of attention to the tick data. So here's the tick data. It's only for the month of June because the Treasury Department takes a couple of months to compile the statistics. But even so, it's a couple of months after April. And so you can see right away, as far as U.S. dollar assets are concerned, foreigners are not shying away from U.S. dollar assets to any extent. In fact, they're buying tons of U.S. dollar assets, with a couple of periodic caveats and some back and forth there. But shying away from U.S. dollar assets, ditching the dollar as far as store of value holdings in financial markets, it's just not happening. In fact, when you hear this narrative come up, you almost never see any facts that go along with it. And the few facts that are brought up are usually something like this, where they're either interpreted backwards or they're interpreted out of context, oftentimes intentionally. But as far as the actual data is concerned, it's not just tick. Tick is actually corroborating and confirming what we know about from all the rest. I mean, just look at the chart for U.S. Treasury yields, for Christ's sake. I mean, U.S. Treasury yields, they were rising toward the end of last year into the early part of January. Right now, even though we got a little bit of a mini sell-off here, which is not unusual fluctuation in the Treasury market, yields are basically stable. The 10-year Treasury yield at 4.33, whatever it is today, is equal to effective federal funds. That's not the market rejecting Treasuries. That's just the mechanics of the Treasury market and steepening, which we won't get into here. I'll get into that in another video. But focusing here, foreigners are not ditching U.S. Treasuries. Now, there was a lot of selling in Treasuries in April, and that has to do with the real mechanics of what happens with Treasury buying and selling in response to dollar funding conditions, which we're not supposed to talk about because that brings up doubts about the Federal Reserve. So outside of April, which makes perfect sense when you understand all these mechanics and what happened in April, outside of April, foreigners cannot buy enough U.S. dollar assets. And that includes a lot of things other than just U.S. Treasuries. There's also agency bonds, corporate bonds, and of course, U.S. equities as well. So you see that when foreigners are selling U.S. dollar assets, and specifically U.S. Treasuries, there's usually nothing good happening in the system. It's usually deflationary dollar shortage conditions, which is exactly what we saw in April. But yet everybody interpreted that in April as something that it wasn't. Again, oftentimes intentionally being disingenuous. Just talking about private sources of buying and selling. A lot of times, too, we do have to make a distinction between the official sector, which is, foreign central banks and reserve managers and other official institutions, versus the private side. So a lot of times what you see is that foreign official institutions are having to sell their U.S. Treasuries to deal with something like April of 2025, whereas at the same time, private sources may not necessarily be having the same thing. So we also have to keep those two different buckets and two different pockets in mind. But even here, I mean, it's basically the same thing. Private sources have been buying U.S. dollar assets. They had to sell them in April because of the extreme nature of the dollar funding conditions, dollar shortage situation that arose. But outside of April, there is no sign, no evidence whatsoever of flight from U.S. dollar assets or U.S. Treasuries specifically. Here's U.S. Treasuries. Again, you can see the same thing. Lots of buying among foreign sources in U.S. Treasuries. There's been selling on a couple of different occasions, which I'll go over right here. The first occasion was last year, starting with November, when we had the dollar spike in exchange value. Again, the opposite correlation. The dollar spikes in exchange value. Foreigners are selling their treasuries, not because they're getting out of treasuries, because what the dollar spiking says about funding conditions in U.S. dollar and the U.S. dollar, the Eurodollar system. When funding conditions become deflationary, naturally, people have to respond to that by selling their reserve assets. Usually, it's foreign official institutions, central banks, and reserve managers. They sell their U.S. Treasuries to liquidate them and get liquid U.S. dollar balances that they can use to try to alleviate the dollar shortage that they're experiencing. But in some pretty extreme cases, even private owners of U.S. Treasuries will use their Treasuries reserve, because private sources have Treasury reserves too, to mobilize them and use them in lieu of being able to fund in the Eurodollar marketplace, in the Eurodollar system. So you saw that last year. Dollar spike, it was December and January in particular. You saw it again in April, and then there's stuff going on in June, which I'll get to here. But it's outside of these periods when we experience these sharp dollar problems, sharp dollar shortages, acute dollar shortages, foreigners are buying U.S. Treasuries. They're buying U.S. dollar assets. They are not fleeing away from them. They are not ditching either one. And the evidence shows that, as if we didn't know that already. I do want to mention here, this video is sponsored by Glint, and this is a perfect segue into the sponsor and what they offer, because we're talking here about too many frequent dollar shortage periods that arise, which is one reason why I tell people you need to own gold. The problem with gold has been, over the last several years, understatement of the century here, for quite a long time, gold had been demonetized. And people who own gold know this. They know only too well. So gold being demonetized means it's an effective store of value at times. In fact, it's a really good store of value during times when you really want a store of value, not for inflationary reasons necessarily, but when things are going bad. Gold is an error hedge. It's a hedge that we saw perform really well, comparatively speaking, in 2008. Same thing that we've seen over the last couple of years as we get increasingly into the forgot how to grow economy that is seemingly remembering how to do worse. So gold as a store of value makes the case for itself. The problem with it is you have to sell it and then turn it into U.S. dollars and then use the U.S. dollars in some way. What Glint is doing, and this is why I like partnering with Glint, they're solving the problem that I've been highlighting for a long period of time, not just with gold, but with other forms of stores of value too. And so what they allow you to do is to take the gold. I mean, you can buy and sell gold and silver with Glint. You can do all that stuff. But you take the gold that you've got with Glint, they give you a MasterCard, and almost everywhere that MasterCard is accepted, you can just stick the card in the thing or use, swipe. You can use the tap to pay, and it takes the funds right out of your gold holdings. You don't have to worry about selling it, what price you're going to sell it at. It's a seamless process to take what is a really good store of value for times like these and use it restore gold to more of a medium of exchange so that it's more a complete and comprehensive form of money. It's both a store of value as well as a medium of exchange in a very modern, mobile, efficient sense. So check out our partner.glintpay.com/Eurodollar and make sure that you use the code SNIDER so that they know that I sent you. They're going to give you a MasterCard or Glint card once you get set up there. Like I said, Gold is a great air hedge, especially for times like these. But here we have the ability to use it as a medium of exchange again, which makes me exceptionally happy because that's the monetary stuff that's been missing out of gold. So thanks, Glint, for sponsoring the video. And like I said, check them out. It's really terrific idea. So back to what we're talking about here, the related dollar superstition. So as everybody believes that there's a loss of faith in the Treasury market, they also believe that the people are fleeing from the U.S. dollar and U.S. dollar assets. And of course, we've already seen the evidence from certainly TIC that shows the complete opposite. Foreigners have no problem buying U.S. dollar assets when U.S. dollar funding conditions are conducive for them to do so. Again, it always comes back to that same solitary problem. When dollar funding conditions are bad, which we're not supposed to talk about, because that means that we're understanding the Federal Reserve is not really a central bank. It doesn't actually do what everybody thinks it does. We're not supposed to talk about that. And since nobody does talk about the dollar shortage stuff, everybody's confused about all this other stuff, selling U.S. Treasuries, the dollar exchange value. Why do all these things happen? Nobody seems to know. So the U.S. dollar exchange value, again, it seems to add evidence to the fact that the dollar, the narrative surrounding foreigners fleeing from U.S. dollars, DXY, which is the main dollar index that everybody uses, fell down to a multi-year low earlier this year, a couple months ago, which seemed as everybody believes that the Treasury market is broken, there's no faith in Treasuries. It that narrative seems to be corroborated by DXY specifically, that has fallen down to a multi-year low. And so if you don't actually look at the charts, you don't actually look at the data, which most people don't have time to do. It's understandable. And so you just hear in the mainstream media, and you hear this from everywhere, from all these different sources, that these things are taking place. And you hear, oh, the dollar is down 11% this year. It's worst year since 1973. And interest rates seem to be rising at the long end. Everybody's ditching Treasuries. You start without actually examining the evidence, because most people don't have time to do so. And again, disingenuously, all the people here commenting in the media don't do the homework, or they don't want to show you what the evidence says. This impression has taken hold for what are understandable reasons. But we actually start looking at the dollar index value. And again, this is why Bloomberg put their weasel sort of fine print statement in the article, was that, okay, one gauge of the US dollar exchange value has lost, a tremendous amount of its value this year. But we're not going to even talk about all the other gauges, which show something very different. So the further you get away from DXY and its heavy influence from the euro, in fact, it's the majority of DXY allocation is to the euro. Once you get away from that, things start to look a lot different. Now, the dollar isn't still exceptionally high. The dollar exchange value has come down from its April or earlier, depending on the index, April high or earlier in the year high, because we don't have the same extreme dollar funding conditions that we had a couple months ago. So in many ways, the dollar is just coming back off of its extremes when it was pushed to those extremes by dollar funding conditions. That's the real correlation here. You see the dollar exchange value go up. Broadly speaking, there's variations on short run periods, but broadly speaking, you see a big move in the dollar going up. That usually means dollar funding conditions. So you move further away from the euro, you look at specifically something like emerging market economy exchange values. And emerging market economies are almost exclusively US dollar borrowers. So what I just told you about the mechanics in the dollar exchange value applies to them almost exclusively. And that's exactly why you see the difference here. So during this period, as we just mentioned, when private sources were selling their U.S. Treasuries back in November and December and January, what was the dollar exchange value doing? It was soaring. Then it started to back off a little bit, but it remained relatively high. In fact, it remained almost historically high, record high, talking specifically about emerging market currencies, from the middle of April into February and then March, and then it hit for the middle of January, February, and March, and then hit a record high on April 9th, which for obvious reasons when we had the meltdown in the marketplace. Since then, we've had things calm down. We haven't seen the level of chaos and disorder and deflation that we did in early April. So that's really all the dollar exchange value has done outside of the euro. It has calmed down and come back down from its historic high to more like where it had been before all of this started. It just lost all the urgency, which pushed the dollar exchange value higher. And it lost the need for foreign reserve managers as well as foreign private holders of U.S. Treasuries. They didn't need to sell their treasuries because dollar funding conditions don't want to say they necessarily normalized, but they were less disorderly and chaotic. So that's what we've seen in the dollar exchange value. Not that it's being ditched or that people are fleeing from it or that it's even crashing, because it's not. The euro, the exchange value to the euro is influencing everybody's perceptions. But you look at this, you look at all of these indexes, including the trade weighted index, which has a heavy allocation to the euro, or the advanced foreign economy index. I mean, yeah, it's a multi-year low, but it's in any realistic context, it's not the dollar crashing. And from the emerging market currency perspective, it's really just off of the extreme highs and still incredibly high to begin with. So the dollar isn't being ditched. The dollar exchange value is not crashing. Nobody's selling U.S. Treasuries. And these two things actually go and correspond very closely together. When we look at specifically foreign official reserve managers and foreign official institutions, the official sector and their holdings of U.S. Treasuries, there is an incredibly close correlation with the U.S. dollar exchange value, because reserve managers and foreign official institutions are highly sensitive to funding conditions in the Eurodollar system, which is behind everything, whether it be the U.S. dollar exchange value or what foreigners are doing with their reserve assets, primarily treasuries and agency bonds. And here you can see the close correlation. When the dollar is spiking, remember, that's an inverted scale, so the dollar going up is down on the chart here. But when you see the dollar spiking, what are reserve managers doing? They're selling their U.S. Treasuries, because the dollar spiking is a signal that funding conditions in the marketplace have gotten to be deflationary. They're disorderly, they're chaotic, it's difficult. So foreign banks that are out there trying to secure dollar funding because they need to, it's a reserve currency, are increasingly unable. And so the foreign official sector responds to those banks being unable to secure the same funding that they need by selling their reserve assets, using the proceeds in one way or another. It could be contingent liabilities, could be a number of different things we don't need to get into here. But they're using the proceeds, after selling the reserve assets, to try to deal with the dollar shortage that their financial system is trying to deal with in the marketplace. That's why you see this close correlation. Whenever foreign officials are selling U.S. Treasuries, the dollar is likely spiking, which is the opposite of what the narrative says. The narrative says the dollar should be going down the same time that everybody's selling their Treasuries. It's the complete opposite to it, because they're missing the Eurodollar mechanics. And so more recently, foreign reserve managers haven't had to sell as many U.S. Treasuries because dollar funding conditions have somewhat normalized after the extremes earlier this year. And so the dollar has relaxed its position. It has come back down from its extreme and its record high a couple months ago. And you can even see it in the tick data. And if you'd rather use DXY, we can do the same thing. DXY has the same correlation with a little bit of variation, a little bit of spin in these short run periods because of the influence of the euro, but overall it's the same thing. And the point I'm trying to make here is what really drives both the treasury market usage by foreigners as well as the dollar exchange value: Eurodollar conditions and Eurodollar mechanics. That's what you need to pay attention to. And because nobody knows about any of these things, everybody's out there, those who are being honest, everybody's out there trying to explain what they see in the US dollar exchange value. They're trying to explain what they think they see in the treasury market, and usually they aren't seeing what they think they see. Without having the full picture and the full information, it becomes difficult, if not impossible. But this is the key point. The Eurodollar conditions drive everything. U.S. dollar exchange value, foreign uses and foreign purchases of U.S. Treasuries, holding of U.S. Treasuries, U.S. dollar assets, it all comes back together. In fact, the most extreme example, the one example most people talk about only at specific times, is China. Same thing. The Chinese tend to be selling their U.S. dollar reserve assets, both U.S. Treasuries as well as agency bonds, which is primarily their biggest holding in U.S. dollar reserves, when we see the dollar going up in exchange value. We see evidence all over the place for dollar shortages and Eurodollar conditions that are disorderly and deflationary. That's when the Chinese sell their U.S. Treasuries. And then you hear zero. You hear absolutely nothing when the Chinese are buying Treasuries and agency bonds back like they did in 2021 and the first half of 2022. Didn't hear anything about the Chinese because they were rebuilding their U.S. dollar reserve assets. At that time, U.S. dollar funding conditions and U.S. dollar availability in the Eurodollar system was much better. So they could build on more U.S. dollar reserve assets, which they did until we got to 2022 when things flipped all the way around. We've been in more deflationary conditions, more difficult Eurodollar funding conditions. And what have they been doing as a result? They've been selling their U.S. Treasuries. It's not a political statement. It has nothing to do with the condition of the U.S. government's fiscal situation. It's entirely driven by Eurodollar mechanics. And unfortunately, because the Federal Reserve is not a central bank and QE's never worked, we're stuck in this back and forth, these extreme motions, what we call Eurodollar 1, 2, 3, 4, and now 5, which means, again, the single biggest factor in all of this is Eurodollar funding conditions. It's not politics. It's not anything else. So the other part of it is talking about the debt crisis. There is a debt crisis. There is absolutely a debt crisis. The federal government is completely out of control, but the thing is the Treasury market is not going to solve that problem. And this is difficult to get people to really understand because they think and they're taught ceteris paribus. If the government issues a ton more debt, interest rates have to rise. Prices of Treasuries have to plummet because there's a ton more debt. What they don't hear is everything that we just went through, which are deflationary conditions and seriously deflationary conditions, which drive demand for safety and liquidity, whether there be foreign participants or domestic participants. In a system that continues to experience these back and forth spasms of Eurodollar and dollar shortages and deflationary conditions, you're going to want safe and liquid assets. So it is not ceteris paribus. It's not as simple as the federal government issuing more debt. Therefore, prices of treasuries have to fall. The federal government issues more debt and the market says, thank you, give me more because of deflationary conditions. Give me more safe and liquid assets at the expense of everything else. The banking sector in particular wants to own safety and liquidity. So if the government issues more treasuries, they're going to buy more treasuries and crowd out the private sector even further, which only harms the economy even more. Plus, combined with these deflationary conditions that are too often too large, you put all that together, you got this perverse downward spiral where the more the U.S. government does and issues treasuries, the more the market wants those treasuries, which makes the economy even worse, which means the more the U.S. government's going to do in response to the worse economy, which means the more there's going to be demand for U.S. treasuries. So the government gets bigger, which is bad in both a political sense as well as an economic sense, because the more the government does, the less efficiency and productivity there is in the economy. Because the only good thing in terms of the economy, the only part that the U.S. government's good at is wasting funds, and this is true of all governments. They all really waste funds, so they make the economy even worse. That's really the issue here. It's not that the Treasury market is going to blow up, and again, we don't see any evidence that it is going to blow up. In fact, we get the opposite because deflationary conditions are the overriding concern. And the more the government does, the more that's going to feed into the same thing. We're stuck in this cycle, the depression economic cycle, that we can't get out of, in part because nobody knows that we're in the depression economic cycle, because everybody's shouting about and everybody believes that there's loss of faith in U.S. treasuries and everybody's fleeing from the U.S. dollar when neither of those things are true. So we don't know what's really wrong because everything you hear across the mainstream media is either backwards or intentionally being wrong. We can go through any number of statistics. We can spend all day with the statistics on the Treasury market. I'll give you a couple here. The short end of the yield curve, everybody talks about the bid to cover. It rises, it falls, and when it falls, that's proof that people are ditching Treasuries. When you look at the 2 years specifically, when you see the bid to cover fall, it's usually because the interest rate on the 2-year is falling, which means there's less of an investment incentive to buy U.S. Treasury or the 2-year U.S. Treasury. Conversely, when we see U.S. 2-year Treasury rise, there's more bids in the marketplace because there's higher return there. So it has nothing to do with the mainstream narrative at all. That's strictly investment consideration, and that's strictly just the bid to cover. But we had a couple, the 10-year auction, 30-year auction was a couple of weeks ago. The bid to cover in the 30-year auction was the lowest that it had been since the horrific bond auction, the horrific long bond auction back in November of 2023, if you remember that one. Everybody went nuts over that one, at least in the short run, because it was quickly forgotten because the market didn't care one bit about that auction. It was in the middle of rallying. We had the bond rally that started up at that point in time because of heightened demand for safety and liquidity, as the entire global economy shifted more firmly into forgot how to grow, if not worse, in some places around the world. So when you see these bid to covers fall like this, it's not really about the Treasury market experiencing a loss of faith. It's simply the mechanics. And just look at the chart here. The bid to cover that we just got in this latest auction was about equal to the horrific auction in November 2023, which used to be normal in the 30-year long bond auction. There's nothing here that suggests that the marketplaces or the Treasury market or Treasury auctions specifically are being, there's a buyer strike in the long end of the yield curve. There's nothing that suggests that's the case. There's some variation in bid to covers. There's some variation in bidding, but that's normal. That happens all the time. It's well within tolerances for the long bond. And there has been very little, if any, response in the secondary marketplace, because when that auction went off, market price didn't move whatsoever. In fact, Bloomberg put out an article on the same day and then stealth edited the story, because in the story itself, after the long bond auction was announced, the article said it's proof that there's loss of faith in U.S. Treasuries. And then when the market didn't even move, the actual secondary rate was the same as the auction, they edited that out and just said, oh, it was a poor auction. They're never poor auctions. Again, that's part of the problem. We don't see poor auctions. And what you do see, apart from people shouting about yield curve control and the need for it, what's happening in the Treasury market, like I said, we'll get to this in a future video, is nothing more than bull steepening, with the emphasis on the steepening term of the overall idea. Market is bull steepening, which means that it has to steepen out, which means long end is going to be behind and going ahead of and higher than the short end of the yield curve. So we see bull steepening happening on the yield curve, which everybody is trying to make into loss of faith in U.S. Treasuries, combined with ignorance over what happened with April, nobody knowing what's really happening as far as the underlying evidence. And so the narrative continues to go on and on and on. And I can't tell you how many times I've heard it more recently, and everybody just assumes it's true because everybody says it's true. But as far as yield curve control and the need that, the idea that the U.S. government has gone too far, we've heard all this before, repeatedly. Back in 2023, perfect example. In the lead up to the horrific 30-year long bond auction, same thing. Everybody said the Fed is going to have to institute yield curve control. That was the topic of conversation during the summer of 2023. That long end rates are going to continue to skyrocket. We got inflation that's across the economy. We've got a rampaging Federal Reserve continuing to spike long-term interest or short-term interest rates that are going to have to be higher for longer. Plus, at the time, especially the third quarter of 2023, the federal government went absolutely insane issuing debt. And so back then, just a couple years ago, of course, this is completely forgotten, we had everybody talking about yield curve control, and of course it never happened because it wasn't necessary, because what matters is Eurodollar mechanics, not all of this noise you get across the mainstream. And as far as Eurodollar mechanics, the final point I want to make here, what the tick data did show was that bank balance sheets, as far as extending short-term liabilities into the rest of the Eurodollar system, they've been moving down sharply. So the rate of increase was already pretty small in the first quarter to begin with, which corresponded with, the rising US dollar and all the conditions that we just talked about. And then in the second, in April, it made sense that that bank balance sheet liabilities and with respect to foreign holdings and in buying and selling and lending and borrowing in the offshore system contracted in April. They came back a little bit in May, but as of the latest tick data for June, and there's some variations within quarters, so that's why we do a full quarter comparisons. But even so, there was a decline in June, which meant for the quarter overall, U.S. banks reported about $33 billion less in dollar liabilities on their own dollar liabilities related to these foreign activities, which, as you can see, that's not necessarily a good sign. In fact, it corresponds with rising disorder and deflationary conditions. So if we're looking at Eurodollar mechanics and the evidence that we do have for them, we've got a lot of evidence, not just the tick data, but here's one powerful piece of evidence that shows all the way to the end of the second quarter, the background in the Eurodollar system is more likely to lead to rising dollar exchange values in the future, not necessarily today or tomorrow, but at some point, as well as foreigners having to sell their U.S. Treasuries if the dollar exchange value goes up because the Eurodollar system is operating at lower capacity, more disorder and dysfunction. Then foreigners are going to be selling U.S. Treasuries not because they're ditching the dollar or because they don't like the U.S. government's credit profile, but because Eurodollar mechanics, dollar shortage situation, all of that stuff is what really drives the entire marketplace, entire global marketplace. Whether you like it or not, whether you realize it or not, that's what actually happened. So the narrative, there isn't even evidence for it just in the behavior of all of these various pieces. But the latest data we got from the Treasury Department on at least the most comprehensive view of these cross-border relationships between U.S. banks, U.S. Treasury holdings, foreigners, all of that stuff. It shows record high. I mean, there is no shortage of demand no shortage of appetite for U.S. dollar assets or U.S. Treasury specifically, apart from these dollar shortage situations. So that's just not happening. There is no flight from Treasury market. It's a 2-decade-old narrative because every time you hear this narrative, and the reason we do hear this narrative is because it's understandable. People are recoiling in horror at the fiscal situation of the government. But like I said, the dollar system, nor the Treasury market or the Treasury system itself is going to solve the U.S. government's debt problem. And in fact, the U.S. government's debt problem is not going to be a problem for the overall dollar system and Treasury environment. That's got its own problems. And that's related to the dollar superstition, as we went over, the dollar exchange value, what the dollar exchange value is really doing. Nobody's fleeing from U.S. dollar assets. They're experiencing deflationary conditions, which causes all of these problems. There is a debt crisis. It's just not a Treasury market crisis. So there's no need for yield curve control because that's based on a narrative which has zero evidence. It has this idea, this fuzzy idea that's based in part on some small amount of truth. And the real takeaway here, because the Eurodollar funding environment is the real background, the real setting for everything that we've been talking about and everything that really matters, the fact that bank funding and bank liabilities with respect to the Eurodollar system contracted through the entire second quarter sets up the third quarter for potentially a rocky period, especially given the fact that September's coming up and we got a couple bottlenecks to pay attention to, and I'll go over those in a future video anyway. So anyway, that's the big data of the weekend. Record foreign holder. There's no evidence anybody's fleeing from U.S. Treasury, U.S. dollar assets. In fact, we got more confirmation and corroboration of the Eurodollar mechanics behind everything. Thank you, everybody, for joining me. Check out Glint. Gold, tremendous asset store value, but also now being moved toward a monetary medium. That's tremendous. So again, check out Glint. Thanks for joining me, and I will see you all again relatively soon.